Welcome back here with Money, and here is our tip of the week. There are many lessons to be learned from one of the most successful investors of all times, Warren Buffett. A lot of Buffett's investment philosophy can actually be found in a note that he wrote to shareholders of his company, Berkshire Hathaway, on what they should be expecting from the company. So a compilation that actually went on to become the basis for many an investment decisions. Well, the owner's manual, as Buffett referred to it, starts with the principle which is to view shares as actually part ownership in the underlying business. So it is this ownership attitude, he says, that separates an investor from a speculator and forms the basis of fundamental stock investing. Well, Buffett also advises that investors should actually rejoice when stock markets fall. He says that there cannot be a better time for investors to actually stock up their portfolio with excellent stocks at very cheap prices than the times when stock markets are sinking. Investors should also invest in companies with high promoter holding. Now, Buffett's principles actually indicate that investors should focus on companies with high promoter stake. He adds that it is beneficial for investors as the stakes of both the owners and the investors actually remain aligned to each other. Another golden rule is that investors should actually analyze companies by per share parameters rather than the aggregate size of the companies, and avoid companies which frequently resort to stock issuances or equity dilution to raise funds. Buffett says he does not like companies where owners are more interested to gain by salaries from their companies rather than business profits. Well, Buffett actually goes on to advise that investors invest in debt-free or low-debt companies. His aim for investors to understand that debt-free companies never go bankrupt. One of the other golden rules, which actually many market greats have also echoed, is that investors should never take a loan to invest in the markets. I think the reasons over here are quite apparent. While Buffett has also believed that investors should avoid companies which frequently acquire other companies in the name of diversification. So we've seen how that turned out recently for one of the listed companies, and trust me, you wouldn't want to be in those shoes. While investors should also actively monitor the business progress of companies and not just the stock price movement. So Warren actually believes that short-term price movements should be meaningless for long-term investors. Rule number 10 says that investors should actually check whether management is creating or destroying shareholders' value. Buffett believes that if a company is not able to generate wealth for its shareholders from the amount of profit that it retains with itself, then it should release that money to shareholders by way of dividends or share buybacks to allow shareholders to deploy their funds on their own. And finally, and this is the one that he actually added much later on, and it's the clincher, which is when to sell a stock. Buffett believes that if a company is doing well, then its stock should never be sold. Investors should stay invested in companies whose business is performing well, irrespective of the share price. Well, I do hope these lessons will stand you in good stead. Viewers, remember, keep writing to us at money@network18online.com. You can also find us on Twitter. Write to CNBC TV 18 News. Use the hashtag money. And remember that you can also log on to YouTube to catch this as well as all our previous episodes. Thanks for watching. We'll see you again next week.